the area which is slightly difficult to decide or decipher about investing. In fact, it's a question which keeps appearing in all our conversations about whether financials should be bought into or should be avoided. What is the way ahead for the financial sector? And are the banks, more importantly, rightly valued? UTI-AMC's Vetri Subramaniam and Piper Serica's Abhay Agarwal have very different and opposing views on the same. Hear out their view.
If there is one sector where we have comfort in terms of valuations, it is actually the entire banking and financial services space in general. This is one of the few sectors in the market, and thankfully it's also a large sector in the market. So we can put money to work in this area because here we have valuation comfort. Well, is credit growth slowing? Of course it is, but I would also submit that it had been very high. Remember, nominal GDP growth, even if you look at the release which came out for GDP growth, nominal GDP growth is currently below 10% in the economy. So in the context of nominal growth being below 10%, a 13 to 14% credit growth is quite comfortable. Remember, RBI itself has been, sort of tackling some parts of the economy or some segments of lending where it had been growing very rapidly. They've actually tried to get people to pull back on that. So there is both an impact of slightly slower growth in the economy as well as actions by RBI which are causing this credit growth to come in slower than where it was a year ago. But I don't see that as anything more than cyclical. And I would actually submit that if credit growth were to turn down significantly, we would have a lot more to worry about because that would be an indicator of significantly slower growth. And significantly slower growth is going to hurt the areas which are priced for growth rather than an area which is not priced for growth. So, my investing philosophy for many years, Neeraj, has always been that cheap valuations or attractive valuations are a function of the market being unable to look beyond current data, but that is where the opportunity is. The opportunity is not where the market perceives the future to be bright and blue skies, and then it's already priced to perfection in those areas. So it's a question of how you think about investing. There are issues in banking, but I'm happy that there are because it's giving me that opportunity to get invested in an area where I have valuation comfort.
The cost of money, cost of deposits is going up. Deposits are more scarce to get. Cost to income ratio is going up across the board. We're seeing because of higher rentals, attrition, salaries. And then you have higher NPAs kicking in. Collection efficiency has down from 98% to 94% for microfinance industry. So there is struggle on all aspects for lenders, including banks, private banks, public sector banks, and NBFCs. Three bets that we already have there. One is, which has been with us since post-COVID, which is what we call capital market infrastructure players, CDSL, CAMS, Angel One, because if the capital markets have to grow, which they will grow, these companies make a lot of money just, because they're basically tech companies that are benefiting from the macro investment theme. The second part is, which is more recent, about 6 months ago, is the insurance players, because we saw a long sideways correction in health insurance companies, in general insurance companies, and in life insurance companies. And after doing a lot of research, we finally placed our bets. And this is not by recommendation, but our model portfolio is known in the market. So we have ICICI Pru, ICICI Lombard, and Star Health in our portfolio because we think that this is a space that has been ignored by the investors, and finally the regulator is getting more friendly